Hi everybody. So this tutorial is going to be a couple of examples and a bit of a demonstration about the concept of absorption costing versus variable costing. So we've spent time talking about the different cost elements that we look at in cost accounting. Initially we talked about what are product costs, what are period costs. We looked at variable expenses and the creation of the contribution margin income statement, which only looks, on the top end of contribution margin. We only look at the variable costs to see if we have enough contribution margin then to cover our fixed expenses. So now we're going to kind of go to the next logical step in discussions about determining our unit product cost, and what that gives rise to is there's like a left and a right side discussion where there are those accountants that believe the absorption costing method to determine your unit product cost is correct, and then there's those who believe that following the variable costing model is actually more accurate. So that's what we're going to look at, what the primary difference is between the two and what the impact of choosing one of these methods over the other is. So let's jump into it. So the key difference between the two methodologies is capturing your fixed costs, okay? Not your fixed selling and administrative, okay, but rather your fixed overhead cost. That's what the critical difference is between the two methods. And remember that when we're looking at a unit product cost, what is important are the costs of production, okay? Only the cost of production. So for testing purposes or discussion purposes, you might be given, the variable selling and admin and your fixed selling and admin, but those are not production costs, so they should never really come into a factor for your product costs, okay? So when we look at under absorption costing, which is also called the full cost method, the key difference, like I said, is including an amount for fixed manufacturing overhead. And this number will change period over period depending on units produced and where your fixed manufacturing overhead actual number comes in at, okay? So in this particular example, we have direct materials, direct labor, variable manufacturing overhead at $2, $4, and $1 respectively, okay? Then if you take a look at the summary here, you'll see that the $2, $4, and $1 apply whether or not you're using absorption or variable costing, okay? So we can say that for under both scenarios, our variable production costs are $7 equally amongst the two, okay? So this doesn't change. So then we get into the fixed cost element, and we're saying, okay, for this company, they had $30,000 in fixed manufacturing overhead. Under absorption costing, I'm going to apply $5 of fixed manufacturing overhead. And it's a very simple calculation. Our total dollars, 30,000, divided by how many units we produce. So 30,000 divided by 6,000, $5 per unit. And under variable, just as the name suggests, we're not taking that into consideration, so there's nothing here. So what ends up happening is that we're saying, if we adopt absorption costing, our unit product cost will be $12 per unit, and under variable costing, it's going to be $7, okay? The other thing that's important for you guys to remember is that, according to the accounting regulatory bodies, okay, so under IFRS, the International Reporting Standards, you have to externally report using the absorption costing method, okay? But the variable method is what's done internally for management to take, this data and then drill down a little bit deeper to extract the fixed costs out of it. And the reason being is that proponents, so the people who are in favor of variable costing, their theory is that whether or not we produce 6,000 units or if we produce 0 units, we still have to pay this $30,000 in fixed manufacturing overhead. We cannot avoid these costs, right? So in the first few weeks, we talked about trying to isolate or determine what are our fixed costs and what are variable, and those that are fixed every month, the rent, the insurance, etc. Whether or not we produce units, we have to pay this money. Okay, so what the people who support, or the accountants rather, that support variable costing are saying, it doesn't make sense to include this as part of our cost because we have to pay this no matter what. Okay, so that's kind of the view between including the amount and not including it. Okay, but I guess the more conservative regulatory bodies say, you have to at least attempt to try to say, of those fixed costs, how much of that can we try to allocate towards these units being produced. And that's why this is the absorption costing method is the one that's used for external reporting purposes. Okay, so just a couple of other points to remember. Okay, so under variable costing, you only want to use the variable costs in your analysis. Okay, so again, only the production costs, never your selling and admin, whether they're variable or fixed. Okay, and the difference for absorption is to include all the variables plus the element of manufacturing overhead. What's the impact on the financial statements, right? So we need to figure out our unit product cost in order to determine our cost of goods manufactured, which we know then once the units are sold, are transferred over to the cost of goods sold and end up on our income statement, okay, as cost of goods sold. So logically we can see here that if we have a $12 per unit cost under absorption costing, on our income statement, we will have a higher cost of goods sold versus under the variable method, okay? Because we're going to report, our cost of goods sold. If it's 6,000 times $12. If we follow the variable costing method, then our cost of goods sold is going to be less. Okay, it'll be 6,000 times 7. Okay, so you should be able to understand and identify that your income statement will be higher using variable. Your net income will be higher if you use variable costing, and lower if you use absorption costing, because you're going to have a higher cost of goods sold. Okay, your contribution margin, sorry. The other thing that you have to understand is that if you don't sell all the units that you produce, you end up with ending inventory. If I produce 6,000 and I only sell 5,000, I have $1,000 of units that need to be included on the balance sheet as an asset as inventory. So you have 1,000 units under absorption costing times $12. Okay, so that's $12,000 of inventory. Under variable costing, you'll have $7,000. So you have a $5,000 difference in your inventory amount, depending on which method you're choosing. And if you're someone who has a keen insight and understanding to cost accounting, what that means, then you'll know that $5,000 difference is because under the absorption costing method, you're actually inventorying some of this cost of manufacturing overhead, whereas under the variable costing method, we're just taking it as a period expense, we're running it through the income statement in that month, charge it as an expense, and it's gone. We're not housing or saving any of this cost on the balance sheet as an inventory asset. So that's the fundamental difference, okay? Absorption costing will give you a lower a higher cost of goods sold, but it will also increase your assets, your inventory balance, if you don't sell all those units. And again, proponents of the variable costing method will suggest that you're really kind of overstating your asset balance, because you're inventorying fixed costs, which in their mind is not something that's really an asset to the company. It should have been gone in the period, match it to the revenues, out it goes, match it to the activity that was completed in that month as a period cost. Okay, so these are the key elements that you have to understand: the impact on the income statement and the balance sheet and the composition to be able to derive at the unit product cost. Okay, some of the key points that I wanted to reiterate. Okay, the key difference between the two methods, variable and absorption costing, is the application of the fixed expenses and whether or not you're going to make them inventoriable costs versus period expenses. Okay, so absorption costing, you're creating these inventoriable costs, and variable costing, you have more period expenses. Okay, and again, the proponents of variable costing argue that these costs would be incurred whether or not, regardless of the production or sales amounts. Therefore, they should be considered as period expenses because they are unavoidable. The rationale for absorption costing is that it causes a product to be measured and reported at its complete cost. So that full cost. Because costs like fixed manufacturing overhead are difficult to identify with a particular unit of output, it does not mean that they were not a cost of that output. As a result, such costs are allocated to products. However valid the claims are in support of absorption costing, the method does suffer from some deficiencies as it relates to enabling sound management decisions. Absorption costing information may not always provide the best signals about how to price a product, reach conclusions about discontinuing a product, and so forth. Okay, so what they're saying is that when you go all in with this full cost method, this absorption costing method, because you're burying that fixed cost number in there, it kind of murkies up the water, that you really aren't getting an accurate picture of what really happened in that month, in terms of costing behavior. And we're going to go through an example in just a second to really explain that. The variable costing logic is to allow for deficiencies in absorption costing data. Strategic finance professionals will often generate supplemental data based on variable costing techniques. So you start with the absorption costing, and then you start to apply the variable costing logic to it to extract this variable cost component to get a different picture of your production costs. Okay, as its name suggests, only variable production costs are assigned to inventory and cost of goods sold. These costs generally consist of direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing costs are regarded as period expenses along with selling, general, and administrative costs. In some ways, this understates the true cost of production. How then can it aid in decision making? The short answer is that the fixed manufacturing overhead is going to be incurred no matter how much is produced. In the long run, a business must recover these costs to survive, but only on a case-by-case basis. Including fixed manufacturing overhead in a product cost analysis can result in some very wrong decisions. Okay? And what we're talking about here is an example like this. Okay? Something simple and straightforward. Assume that a company produces 10,000 units of a product. Okay, so we have 10,000 units of production, and the per unit costs are $2 for direct material, $3 for direct labor, and $4 for variable factory overhead. So right off the hop, we know that under both methods, we're already at $7, $8, $9 in variable production costs. Okay. In addition, fixed factory overhead amounts to $10,000. Therefore, $10,000 divided by 10,000 units of output, we have $1 per unit of fixed factory overhead. So under the variable costing method, the product cost will be limited only to our variable costs, therefore $9. Under the absorption costing method, it will be $10. Okay, it'll be 2 plus 3 plus 4 plus 1. So $10 under absorption costing and $9 under variable. And so now let's consider a situation where this becomes a conflict. Okay, assume that the company's approach to sell one additional unit at $9.50. This sale will not result in any added SG&A, which is key in being able to come to the right conclusion. Okay, so your expenses will not go up as a result of selling this one extra unit, and it will not impact sales of any other units. So you won't lose sales by attaining this one sale. Okay, two critical pieces of information. So right away, if you were without going on and reading, we have a $10 cost compared to a $9.50 sale price. We're losing 50 cents. Under variable, we have a $9 cost, and we're selling at $9.50. We're making 50 cents. So now you're a bit conflicted and confused. What's the right solution here? What's the right way to approach whether or not we should take on this extra sale? Based on absorption costing methods, the additional unit appears to produce a loss of 50 cents, and it appears that the correct decision is to not make the sale. Variable costing suggests a profit of 50 cents, and the information appears to support a decision to make the sale. Management may well decide to sell the additional unit at $9.50 and produce the extra 50 cents for the bottom line. Remember, no other costs will be generated by accepting this proposed transaction. If management was limited only to the absorption costing information, this opportunity would have likely been foregone. So there's a couple of points in there that, hopefully it resonate and will stick with you. Okay? So the first thing in this very last line, if a company only produces information using the absorption costing information, you could potentially be losing money. Okay, because you will just look at it from the point of view of the 10 versus the 950, not taking it on, done. But by taking the time, okay, and having the resources available to complete the variable costing analysis within your company, then you can start to dissect the the costing information better, to have a clear understanding of what scenarios are actually opportunities and what scenarios are actually a risk that should be avoided. Okay, and in this particular scenario, because we know that we will not have any additional costs, there is no reason why we wouldn't want to add to our bottom line if we have the opportunity to do so. So this is just a very brief example of the difference between the two methods and how they impact management decision, and where the value comes into an organization by adding in variable costing analysis and reporting, and having that resource within your company to make sure that you're making the right business decisions. Okay. So now I wanted to show you guys a little bit another comprehensive example here that includes the income statement. Okay, so here's a company. They produced 40,000 units. They've sold 35,000. We have our selling price. We have underselling and administrative expenses. We have our amounts, our manufacturing costs, direct material, direct labor, variable manufacturing overhead, and our fixed manufacturing overhead. Okay, so step one, same like we did on the first tab, is to calculate our variable and absorption costing unit product cost. Okay, so we know that direct material, direct labor, and variable manufacturing overhead apply under both scenarios. So 30, 14, and 14 apply to both. Next is the fixed manufacturing overhead. Under variable costing, we don't apply any fixed overhead, so we have a product cost for under the variable method of $48. Under absorption costing, we have to figure out how much of the fixed manufacturing overhead to allocate. So we're going to just take our total amount of 1.28 million and divide it by our units produced. Okay, what you want to remember when you're looking at questions is that you don't want to get confused by all the quantities that you're given. If we need to apply product costs, we need to look at the production amounts, not the sold, but the production amount. So 1.28 million divided by 40,000 gives us $32 to apply in fixed overhead per unit. So we end up with 48 compared to $80. Clearly a huge difference, and obviously right off the hop you should know that our income statement, our cost of goods sold, under absorption costing, the cost of goods sold is going to be much, much higher. Okay, so the next part of this question was to complete the income statements. Okay, so sales, static for both. Your 35,000 units sold times your selling price, the 4.2 million. Okay, so now we look at where things start to get different. Under the absorption costing method, we have zero beginning inventory. We have cost of goods manufactured. So now we're taking our 40,000 times the $80 that we calculated. Our goods available for sale, 3.2 million. But we only sold 35,000 of the 40. So if that means 5,000 is left behind in inventory. So 5,000 units times $80 is 400,000. Subtract the ending inventory from your goods available. Our cost of goods that have been sold, 2.8 million. Subtract the 2.8 from the 4.2 and we have gross profit of 1.4 million. And then we deduct our selling and administrative expenses, fixed and variable, and we end up with net income of $140,000. Looking good. Then we go over to the variable costing side. Our sales number doesn't change. Our cost of goods manufactured are going to be the 40,000 units produced multiplied by our $48 cost. Our goods available for sale, 1.9 million. And again, we have to subtract the ending inventory that hasn't been sold. So 5,000 units times 48, 1.68 is our cost of good manufactured. Our gross contribution margin, okay, contribution margin income statement. We looked at this a couple of weeks back. We have gross contribution margin of 2.5 million, but we still need to subtract the variable selling and administrative expenses of 140K, leaves us with contribution margin of 2.38 million. Okay, you remember the contribution format income statement, you have your variable expenses up on the top portion to determine your contribution margin, and then your fixed expenses afterwards. We don't blend them like we do on the traditional format. Okay, so contribution margin is 2.38 million, and then we deduct our fixed manufacturing overhead of 1.28, the total amount for the period, and our total amount of fixed selling and admin 1.1, and we have a net loss of 20,000. Why do we have a loss? Because we are absorbing all of the fixed manufacturing overhead during this period. Okay, you have to make sure that you completely understand that that's what is going to cause a difference between the income under the two different approaches. Okay, in general, you're going to be asked to reconcile the difference between the two methods. So to reconcile the $160,000 difference between 140 and negative 20 is 160,000, which is because we're carrying 5,000 units in ending inventory multiplied by the $32 per unit fixed cost portion equals 160,000. Okay, we're taking 1.28 million in overhead under the variable costing method versus 1.12. The difference between the 1.28 and the 1.12 is 160,000. Okay, so that's how you would reconcile the difference between the two and explain it to someone within the company who wants to know, hold on a second, why do I have 140,000 when I look at it under the absorption costing method, and why do we have a loss, which is alarming under the second method? And you would explain, because we're hiding or we're storing inventoriable cost, because we're storing $160,000 in costs in inventory, and that's exactly why the people who are proponents of variable costing prefer this method, because it looks more transparent. We're not hiding any of the fixed cost that was incurred by moving it over onto the balance sheet as an inventory cost until we sell those items. So that's the back and forth that goes on between cost accounting and accountants in general. Which number or which approach is the best way to look at it. Again, the regulatory bodies say let's go with this full cost method because we need to apply some of that fixed cost towards the unit the product unit cost. But if you have someone who's not well versed in accounting, that's looking at the financial statements, they might not really understand that this fixed cost number of 1.1 million is related to some of that inventory cost that we're carrying on the balance sheet, and that it actually, in some eyes, we should have taken that amount as a period cost because it actually occurred in that month. So, that's kind of how the back and forth, the debate and discussion between these two methods goes along. So, this just is a great way to give you a visual to show you what the difference looks like, where the differences are. They're going to be in your cost of goods manufactured number, and also in your balance sheet. You're going to have a higher asset balance on your absorption cost. If you're following absorption costing, you're going to have a higher inventory asset balance than you would looking at the variable costing side of things. Okay, so hopefully now that we've kind of walked through a bit of an example, these components or these elements, make a little bit more sense. Again, cost accounting is such a huge topic in itself, and there's so many different elements. So, as an introduction, this is just for you to get an idea of what the basics are when we look at absorption costing and variable costing, what the differences are, how it impacts the financial statements, and it's again critical that you understand how to be able to reconcile these two numbers and how they relate to themselves, and that the only answer is ever going to be because of the fixed cost being inventoried under the absorption costing method. All right, so good luck in your studies and understanding variable costing and absorption costing, and read up as much as you can on this very interesting and debatable topic. Thank you.